So buying a home can be a very exciting milestone in your life. But the truth is, when you need to obtain financing or get a mortgage in order to do that, there's a very specific set of rules that you need to follow in order to be successful in that process. So this is going to be a real short video series about what to do and what not to do during that process. Because the decisions that you make leading up to the purchase of your home can impact the terms that you qualify for on your loan, or even whether you qualify at all. So first I want to talk about how applying for new credit or other loans can have unintended consequences when purchasing your home, and here's why. Okay guys, so when you're in the process of purchasing a home, or even in the months leading up to purchasing your home, it's very important that you don't open up new lines of credit, have your credit pulled, and there's a couple important reasons why. And this may have been something that you've heard in the past, and maybe just didn't fully understand all the reasons why, or maybe you've never heard this before, but that's what I want to tackle and break down in this video for you. So there's three major components that I broke down, and that's, first of all, the credit check itself. In order to open up another large account, that can have an impact on your score. Then if you actually qualify and open the account, that can affect your score as well as your debt to income ratio. And the third thing is it can cause additional documentation and lengthen the process. So starting at the first one, the credit check all alone by itself can have an impact on your score. So the view of lenders is typically if you have your credit pulled once or twice, it's not going to have a major impact. It could be maybe 2 to 5 points. It'll drop your score on a hard credit inquiry. Now, if you're getting excessive with that, it can start to have larger impacts because creditors can view that as a negative, that you're going wild and you could open multiple accounts and fail to be able to pay them. So that could have a larger impact. But even if you have a single credit check, and let's say it affects 2 to 5 points, that can it can be a big deal, or it may not be a big deal, depends on your situation, but it's just a risk that I wouldn't be willing to take. Because when it comes to mortgages and the interest rate that you qualify for, approximately every 10 points of your credit score is what's called an LLPA, or a loan level pricing adjustment. And that could cause a higher interest rate each 10 points that you go down, or it could cause a higher cost for that rate. So if you have a 2 to 5 point hit, you can see how pretty easily that could change which 10-point threshold that you're in there. And if you take even a slightly higher interest rate, that affects your payment, and that could affect 30 years worth of payments, or however long you take the loan out for. So you can see how even just the credit pull can have a big impact on your qualification and the scenario that you qualify for. So that's the credit score. Now, if you actually qualify, number two, if you actually qualify and open up a new account, that can have a much larger impact on your score. First of all, for example, about 10 to 15% of the makeup of your credit score is the average length that your accounts on your credit have been open. So, of course, if you open a brand new account, that will immediately drop your average length of accounts being open. And that's a pretty big percentage, 10 to 15% makeup of your credit score. So that typically will drop your score. Also, if you say open up a Home Depot or Lowe's account or some sort of furniture credit card, and you qualify for $2,000 and you purchase for $2,000, that is now a maxed out revolving credit line, and a maxed out credit line can drastically drop your score. So there's going to be some other factors that go into that too, to opening up a new line of credit or a new loan, but this can have a big impact on your score. And then the more obvious one is it can impact your debt to income ratio. So now if you have a new $300 payment, you may not qualify for as much as you initially did, or what you could have if you hadn't done that. So opening up a new account you can see drastically affect whether you qualify at all or how much you qualify for. And lastly, the third thing is it can cause additional documentation. So when you open up a new account, it's not uncommon for that account to not show on your credit report for 2 to even 3 months sometimes. So if you just recently opened that up, us as a mortgage lender are going to look at your credit report and lean heavily on that. Well, we're also going to see recent credit inquiries that you had. And if you have a recent credit inquiry that we don't see a new account on your credit profile, we're going to ask you about it. And if you did open a new account, instead of what we normally do, just looking at your credit report. Now we have to get documentation to show it, and it has to be just a very specific documentation, and it might be difficult for you to find that. So it can just lengthen out the process, and it causes more documentation, and that could cause contractual issues, and it can really cause the process to slow down drastically. So those are three major ways that opening up credit lines or even having your credit pulled during the loan process or leading up to purchasing your home can change your qualification drastically or cause you not to qualify. So always, before you make any major purchase, reach out to a mortgage professional. Let them run your numbers or look at your scenario and see how that'll impact you. Best rule of thumb is just don't do it. Don't make any major changes. And if you can avoid making those changes, you'll qualify for a better overall loan for yourself and your family and a smoother overall process. All right, guys, thanks a lot. This is another common mistake we see. Don't make this mistake.